So first of all, thank you all for joining. I'm excited to be here. Hopefully you are all Airbnb employees, and this is a webinar on how you as Airbnb employees can make the most of your Airbnb equity. So before we get started into the heart of the webinar, I want to share a story with you, personal story, just to explain why I'm here. So I'll take you back to the late 90s. I was working at a tech startup. I remember it as if it were yesterday. I was in my cube and I could hear the sound of champagne corks popping. Everyone was high-fiving each other. We were all very happy. We were all very excited because our company had done what any tech startup at that time dreamed of doing. Is we had our IPO. And so everyone was extremely excited and feeling good. And we watched over the next months as the stock price kept going higher and higher. We all felt even better. I had a bunch of ISOs, incentive stock options. And then at one point, the stock hit $125 a share, and I remember my ISAs were a few bucks a share for their exercise price. I remember thinking to myself, it was my late 20s, and I was thinking, if this keeps going up, I may be able to retire in a few years. Now, of course, as you can see, I'm not retired. What happened was, for those of you who know history, the dot-com bubble burst. I was at a dot-com. My company shut down. All of my stock, all of my assets, which I held, went to zero. And I, as if that weren't enough, I realized I ended up owing some taxes on those because they were ISAs. So one important thing that came out of that experience was that I realized, hey, I got to educate myself about my equity. I don't really understand how this works. I talked to a bunch of my coworkers, and I realized most of them didn't understand how it worked. And so I realized, I'm going to start to educate myself. And that really started me down the path. Ended up making a career change into financial planning. And the reason I built this firm and the reason I'm here talking to you today as Airbnb employees is because I want to make sure that you, as an Airbnb employee, are able to make the most of your equity. I know you worked hard for it and you want to make sure you get some value out of it. So that's why I'm here today. Hope you learned something. All right, so let's get started. I'm going to share some slides with you. Okay, actually, before I go any further, can everyone hear me and see me? Okay. Everyone hear me and see me okay? Okay, good. Getting some thumbs up. Okay, so we are here today to talk about how you guys can make the most of your Airbnb equity. All right. Now, this is all for educational purposes, so you should talk to your professional before you make any decisions. So here's what we're going to cover today. I've given you a bit about my background, tell you just a bit more, and then we'll get into the heart of the webinar here. So we'll talk about what type of Airbnb equity do you have? Should you sign up for your ESPP? Do you have too much equity? And then the question I think most of you are thinking about is, hey, help me understand, when should I sell my Airbnb equity? So we'll talk you through a framework for thinking about that. And then once you sell your equity, what should you do with your proceeds? And then we'll wrap up with next steps, Q&A. So my current plan is to take you through the presentation. It'll take 45, 50 minutes, and then we'll have 10, 15 minutes for live Q&A. Okay. So we'll take a look at the clock. My goal is to get you out of here by noon. Now, one thing I've done webinars before. I know some people are perfectly happy and comfortable to share their questions with live Q&A. I know others are not as comfortable. So what I want to do in addition to that is I'm going to have free one-on-one virtual sessions. So this is simply, we'll just have a Zoom call available if you have specific questions about your specific situation that you may not want to ask as part of a live Q&A. So I'm going to drop into the chat now a link. Let me do that now. So that's just a link to my calendar. If you have something you want to talk about specific to your situation, you don't want to do through the Q&A, then feel free to click on that and you can do that. Couple other things. Q&A, you can drop in questions as we go through. I'm going to answer at the end. I'm the only one here, so I'm not monitoring that. So I'll scroll back through that at the end. So you can drop them in when you want. And then also there will be a recording. So as long as you registered for the webinar, I think within a day or so, you'll get an email with a recording to the replay in case you miss anything or you have to drop off. Okay, so let's get started here. So here's my background. As I said, I worked in Silicon Valley for about 20 years at some startups and then bigger companies like Yahoo, eBay, Intuit. Then I made a career change into financial planning. And as I said, really, I built this firm because I wanted to make sure I only work with tech people with equity. So I specifically help tech people with ongoing financial planning and investment management. So people who want help with that, and typically clients are coming in with a couple of million of vested equity, savings, investments, retirement assets. So that's who I typically work with. All right, so that's a bit about me. All right, so what type of Airbnb equity do you have? All right, so the three main types of equity that Airbnb employees have are restricted stock units, RSUs, non-qualified stock options and NSOs, incentive stock options, ISOs. And the reason it's important to understand what type of equity you have is because each type has a different tax treatment. And if you want to minimize taxes, then you need to start by understanding what type of equity do you have. Okay, so I want to take a quick poll because I want to understand where everyone is in terms of what type of equity you have. So I'm going to I just published that. So the question is, what type of Airbnb employee equity do you have? So everyone take a moment here and answer. I'm seeing 100% RSUs, which I'm not surprised by. All right. We are all at 100%. Oh, there we go. Somebody has some ISOs. Okay. RSUs and ISOs. Okay, so we are at 98% RSUs and ISOs. Okay, so I'm going to go ahead and close the poll. Thank you all for participating. Okay, so we're 97.9% RSUs, 2.1% RSUs and ISOs. So I'm going to focus on RSUs. I'll touch briefly on NSOs and ISOs because it's important. There's at least some of you who have ISOs, but even if you don't have NSOs or ISOs at Airbnb, if you stay in tech, you will likely, or it's possible you will encounter this. So it is important to understand how those work. Let's talk about RSUs. Okay, so let's talk about Airbnb RSUs. So as you guys know, this is compensation in the form of Airbnb shares that vest over time. Okay. And the typical vesting schedule I see with Airbnb employees is it's a 4-year vesting period. There's a 1-year cliff, meaning after 1 year, you vest 25%, and then you start to vest quarterly until you vest 100% at 4 years. Okay. That's for your initial grant. You guys may have follow-on grants, but they are typically following that same vesting schedule. I have seen variations, but that's the most common. Okay, so let's talk about the tax treatment. Okay, when you are granted your RSUs, typically when you start your initial grant, you don't have to pay any taxes, 0 ordinary income taxes. Okay. Now, when you vest, you have to pay ordinary income immediately on the day you vest on the fair market value of your stock. Okay. So the way it typically works at Airbnb, let's say you have, I'm going to keep the math simple here. Let's say you vest $100,000 worth of RSUs. Airbnb is going to calculate withholding for taxes and other Social Security, et cetera. They will sell how much, let's say it's 40,000. They'll sell $40,000 worth of the RSUs. You're left with 60,000. That's what they put into your Fidelity employee equity account. So that's what you end up with. So you may vest 100,000, but you end up with 60,000 in your account. So that's the tip, and that's you paying your ordinary income tax, federal and California, if you're in California, and state. Now, one thing to highlight, to be aware of, is that you want to ask yourself, hey, have the taxes on your RSUs been under withheld? Okay, and what that means is, let's say you're at the highest federal income tax bracket, which is 37%. Typically, withholding is at 22% for federal. So in that case, you're going to have to pay 37% on those RSUs. You're being withheld at 22%, meaning you are being under withheld 15%. So that means you're going to have to pay the IRS those taxes come April, even though they haven't withheld it. Okay. So I have clients who come to me and they say, I had to pay, and the way this shows up is a big surprise tax bill in April. Okay. And so I have clients come to me and say, hey, why is this happening? Well, it doesn't, and with my clients, we'll make sure and either do estimated taxes every quarter, set aside a tax reserve so that surprise doesn't happen. But that's something you should be aware of. And I have many people who come in and say, yeah, I end up owning a bunch of taxes. I don't know why, because I thought they withheld the taxes at when I vested. The answer is they may have under withheld. Okay, so that's how the taxes work. Now, when you get your RSUs, one thing that's helpful for clients is I'll say, hey, think of it as a cash bonus in the form of Airbnb stock. And the reason you can think of it like that is because you get taxed immediately when you're vested. And that's different from options. I'll share in a couple slides why it's different from ISOs and NSOs. Okay, but people get that mixed up in their head. So as I'll just walk you through these two quick examples. So if you have the Airbnb RSU version, what happens is Airbnb gives you 100,000 in RSUs, right? They sell the 40,000. They leave you with 60,000 in Airbnb stock. So that's what you end up with. Different version. Let's say Airbnb gives you a cash bonus of 100,000. Okay. They take out taxes, etc. 40,000. You get 60,000 in your checking account. You take the 60,000, you go in the stock market, and you buy 60,000 of Airbnb stock. In both versions, you end up in exactly the same place. You've got 60,000 of Airbnb stock, if you get cash or if you get your RSUs. Okay. That's one way to think about it, which helps clarify exactly what RSUs are. So the question I ask clients and that you want to ask yourself is, all right, if Airbnb gave you cash bonus today, would the first thing that you do with that cash be to go and buy Airbnb stock? Because if you hold your RSUs, then it is exactly the same as buying the stock at the current price. Okay, so that's a question you want to ask yourself. Most cases, clients will say, it's probably not the first thing I would do. Okay, so if it's not the first thing you would do, then you should consider selling those RSUs. Now, whether you sell, when you sell, depends on your specific situation, your goals, your concentration, your taxes. So you want to think about that carefully. We're going to talk about it later in the presentation. And you may want to talk to a professional to help you through that. Now, in general, what I recommend is you sell as soon as you vest, because remember, there's no tax benefit for holding it. It's just like cash, right? It's just like you get a cash bonus. Now, one common misperception I hear from a lot of people is, oh, well, if I hold my RSUs for a year, then I get long-term capital gains treatment on that. Okay, so let's think about this. If you vest your RSU today, it's worth $100. Okay, you sell it more than a year from now, let's say it's $110. Okay, you do get long-term capital gains tax treatment, but it's only on that $10 gain. Okay, you got taxed immediately at your ordinary income tax rate when you vested. So the $10 gain gets long-term capital gains. Now, let's go back to the other version. You get $100 in cash, you go buy a share of Airbnb for $100. You hold it more than a year, you sell it, you get a $10 gain, you get long-term capital gains treatment on that $10 gain. So again, you're in exactly the same place. So there is no tax benefit for holding your RSUs. Okay, you get long-term cap gains on the gain, but you get that anyway. All right. So that is my general recommendation. We'll talk about ways to think about that, because I'm guessing lots of you have lots of RSUs. Okay, so let's talk briefly about NSOs. So NSOs are non-qualified stock options. They give you the right to buy the stock, but not the obligation. You don't have to buy it. Now, this is helpful to understand versus RSUs. So when you're granted, you don't owe any ordinary income. Also, when you vest, you don't owe any ordinary income. Different from RSUs, right? You have to pay taxes when you exercise the option. Okay, and you got to pay taxes, ordinary income, on the difference between what we call the spread, or the difference between your strike price and the fair market value. So if your strike price is $10 an option, the fair market value is $110. That $100 difference, you have to pay ordinary income tax on that. Okay, when you exercise. Again, you got to figure out your specific situation when to exercise, but a general guideline is, if you don't have a valid reason to exercise early, and valid reasons are you need the cash. So for example, if I'm going to go buy a house and need a down payment, yeah, go ahead. That's a valid reason. Then I recommend typically you exercise when you get close to the expiration date. So 1 to 2 years, roughly. So most NSOs are either have a 7 or 10-year expiration. Okay, so you would hold your NSO. This assumes you stay at Airbnb until you get close to the expiration. And the reason why is because there are two types of value in that NSO. The first is what's called the intrinsic value. That is the difference between your strike price and the fair market value. Everybody gets that. The second component is what's called time value. That means the longer you have before the NSO expires, the more value there is in there. So the way to think about this is if I asked you, would you rather have an NSO that expires tomorrow, or would you rather have an NSO that expires 10 years from now? Most of you would say, I'll take the one that expires 10 years from now. That's because the likelihood of the stock going up 10 years from now is much greater than by tomorrow. Okay, so that's the time value. So if you wait until you get to 1 to 2 years, then you are capturing most of that time value. Okay, so that's NSOs. So finally, let's talk about incentive stock options, or ISOs. Okay, so this is similar, right to buy the stock, but not the obligation, but you get a key tax benefit. Okay, so those with ISOs, this is really important. When you're granted your ISOs, when you vest them, and when you exercise them, you owe zero in ordinary income. Okay, different from NSOs, different from RSUs. Okay. However, be aware you may have to pay what's called alternative minimum tax, AMT, which is a parallel tax calculation. You do it every year, or your tax person does. Whichever one is higher is the one you pay. Usually it's ordinary income, but AMT counts different types of income differently. Specifically, it counts ISO income, the difference between your exercise price and the fair market value, as income for AMT purposes. So, you got to have a tax person run that, or that ideally to figure out if you're going to owe AMT. But the benefit is that if you exercise, you're able to pay the lower long-term capital gains tax rate if you sell it more than 2 years after your grant date, more than a year after you exercise. So if you exercise, hold it more than a year, qualifies for long-term capital gains. Okay, federal highest ordinary income tax rate is 37%. The highest long-term capital gains tax rate is 20%. So that's a 17% savings potentially. If you got $1 million in Airbnb equity and ISOs, you hold them for a year, you could save, in that case, $170,000. So that is significant. That is the opportunity that ISOs offer. That's the tax benefit. You can save on taxes if you manage your ISOs correctly. And I'll just give you a quick example. One of the things I do with my clients to optimize ISOs. It's what I call minimize the AMT strategy. So I have clients who don't want to pay any AMT, but they want to take advantage of the long-term cap gains. So what we do is go to a tax professional. We'll do tax projections. We'll understand how many ISOs can you exercise just before AMT kicks in. It's called the AMT crossover point. Once we know that, then the client will exercise the ISOs. Okay, that means the clock starts on the long-term capital gains, qualifying for long-term cap gains. If they hold it more than a year, they're going to pay long-term cap gains on it. But because we haven't gone over the AMT crossover point, client doesn't have to pay any AMT. So you can do part of your ISOs every year, not paying AMT, but start to qualify those ISOs for long-term cap gains. Okay. Takeaway on ISOs really is there's a big opportunity to save a lot on taxes because of that tax benefit. Okay, so that's ISOs. Let's take a minute here and talk about should you sign up for the Airbnb ESPP, Employee Stock Purchase Plan. So before we actually get started on this, I want to figure out another quick poll here. So I just published that. If you guys can answer that, are you currently signed up for the Airbnb ESPP? All right, so looks like right now Majority are. We're in the 80s. Some of you are no. Okay. So we get a few more seconds. Looks like we're going to end around 80-20. Okay. So I'm going to close that poll. Thanks everybody for doing that. We are at 84% yes, 16% no. Okay, great. So then a lot of you are already familiar with this. Some of you are may not be. So let me walk you through the basics. Okay, it's a Airbnb employee stock purchase plan. It's an employee benefit. It's a way to buy Airbnb stock at a discount. Okay, and so you get a 15% discount on the lower of the price at the start of the offering period and the price at the end of the offering period. Offering period Airbnb is 6 months. Okay. And the way it works is you just sign up during the enrollment period and you can choose a percentage from 1 to 15% of your pay that will be used to purchase Airbnb stock through the employee stock purchase plan. So what happens is every paycheck, they take that percent out and it accumulates in the ESPP account for 6 months. At the end of the period, they use those funds to buy Airbnb stock at the discounted price that we just talked about. Okay. Now, from a tax perspective, no income tax impact when you purchase. Okay. Now, you're going to pay ordinary income tax when you sell unless both of these things are true. You have to hold it more than a year after your purchase and then more than 2 years after your grant date. The grant date is typically the beginning of the offering period. Okay. So that adds 6 months. So it's really 1.5 years after your purchase typically. Now, if both of these are true, you qualify for that long-term capital gains tax rate. Now, that's you want to remember that. But let me explain why there is quite a bit of value in this. Okay. So you can earn around an 18% return for dollars that are invested only about 3 months on average through the SPP. And this is not a return you can get anywhere else in the real world, right? So let me just walk you through an example to explain how this works. Okay, so Airbnb has an ESPP, 15% discount. Let's assume the price is $100 at the beginning and the end. Okay, let's assume you contribute $8,500 during that 6-month offering period. Okay, so Airbnb takes the lower of the two stock prices, so both are at $100, means you get a 15% discount, you get $85 per share. So you get 100 shares at $85 per share for your $8,500. Okay, now you have Airbnb stock worth $10,000 that you only paid $8,500 for. Okay, so do the math, $1,500 gain over 8,500, that's a 17.65% return, 18% return. Now remember, you invested your first dollar about 6 months ago, first paycheck of the offering period, and then your last dollar came in just a few days ago from the last paycheck for the offering period. So on average, your dollars were only invested for about 3 months. Okay, so this is how you get to earning about 18% for dollars that invested only about 3 months. And a kicker, if the price increases at the end of the offering period, your return also increases. Okay. But this is, on average, you can see on your money right now, if you have a savings account, you're earning nothing. If you have it in stocks over the long run, you're going to earn, 6 to 8%, something like that. This return is actually a great return. So, given that this is the discount you get this kind of return, and this is relatively low risk if you can sell it within a few days after the purchase date. Okay. So that's what I typically recommend for clients. It depends on how the trading windows fall, et cetera. But I typically have clients sell their ESPP shares as soon as they can. And the reason why is because then you can lock in your discount, you lock in your return. If you say, I want to hold it for the long-term cap gains, you have to hold it more than a year. And because of the volatility of the stock, it could drop and then your discount doesn't matter. You lose it all. Okay, that's potentially it. So if you're willing to do this, it's relatively low risk, then I recommend maxing out your contribution to the full 15%. That is, unless you don't have enough cash from your paycheck to support your living expenses. If not, then I'd just figure out what you can max out and do that percentage when the window, as soon as you do the purchase, sell it as soon as you can, and then you get some significant return on that because of the discount. Okay. All right. So let's talk about, this is a question you may or may not have thought about. Do you have too much Airbnb equity? So there's this concept of concentrated stock position, which is when you own too much of a single company stock. All right. And my general guideline is more than 20% of your investable assets. If you have more than 20% of your investable assets in a single company stock, you are highly concentrated. Okay. And that means that you have much higher risk volatility than a diversified portfolio. And you guys have already lived this, right? You've seen Airbnb stock go up and down. And so you understand what concentration does to you. Now, the true risk of this is illustrated with this example here. Okay. Enron was a high-flying energy company back in the late 90s. Wall Street loved it. Everybody loved it. Stock kept going up and up. At one point, early 2000, to hit $90 a share. And then some bad news came out. There was an accounting scandal. And then within months, the stock was worth nothing. Okay. The reason this illustrates concentration is there were many Enron employees who had lots of Enron stock. And the reason why is because when you contribute to your 401k, you could actually invest in the company stock. The company match could be made in company stock. You could also invest outside of the 401k. And so there were Enron employees who had a ton of concentration, almost everything in Enron stock. And there were employees who lost hundreds of thousands of dollars, almost their entire retirement savings account, retirement savings, because they had it all in Enron stock and because they were too highly concentrated. This is the real risk of being too highly concentrated, is that something that happens beyond your control to the company, if it's too much of your net worth, then it can mean very bad things. Okay, so your next question for me as well, how do I figure out if I have too much concentration? So I'm going to walk you through here step by step. And you can just do this in your head, ballpark number. So step one is you just calculate the total value of your vested Airbnb equity. So everything you got, ISOs, NSOs, RSUs, ESPP. Just use the current stock price. That gives you a number. Okay, step two, calculate the total value of your investable assets. That's your savings, your investments, retirement, 401k. Add that up, add your equity. I'm not, for purposes of this exercise, I'm not including real estate, your house, etc. Step three is you just divide the total value of the vested Airbnb equity by the total value of your investable assets. That's your percentage of concentration. And then in general, if your concentration is more than 20%, you're highly concentrated and you should think about diversifying. Okay, so let me give you a quick example here. You got 4,000 RSUs, vested RSUs, $100 a share. That's 400,000, okay, in Airbnb equity. This is keeping the math simple. Add up your savings, investments, 401ks. You have 600,000 total investable assets, okay? That's outside your equity. You add your 400,000 of equity, your 600,000, that gives you $1 million of total investable assets. You take your 400,000 of equity, you divide it by the million, that's 40% concentration. 40% is greater than 20%, which means you're highly concentrated. So you guys take a moment and do that. Now, I just want to acknowledge that, again, I work with tech people with equity. That's all I work with. So I have plenty of clients who come in who have concentration of 50%, 80%, 95%. So it's not uncommon, especially here in Silicon Valley. So let's do a quick poll here to get a sense of if you do this in your head, or if you have done this before, how concentrated are you with your Airbnb equity? And this will give you a sense of the reality. So it looks like we have people in all categories here. Yeah, it looks like things are even out. And as I said, for Silicon Valley, this is certainly not unusual, because we're right now showing 14%, 80 to 100. Not shocking. Okay, so just take a few more seconds. I'm going to close this. We are at, here's where we ended. 0 to 20%, 19% of you are. 20 to 40%, so concentration, 23%. 40 to 60%, 35%. 60, 80, about 10%, 80 to 100, 13%. So what that means, that based on my general guideline here, 20%, that means 80% of you guys are highly concentrated. Okay, not surprising. But what that means is, let's think about, hey, how are we going to reduce that concentration? Okay, thanks for that. All right, so the question you guys are all trying to figure out, when should you sell your Airbnb equity? Okay, so I'm going to give you a framework for thinking about this, how to do this. Okay, you got to make your own decisions, but you got to figure out what you're comfortable with. So the framework is this. I would first start by figuring out, okay, do I have any valid near-term cash needs? Okay, that means good reasons that I need cash. And so some examples of that are taxes. I got to pay taxes on my equity. So for example, your RSUs, if you're under withheld, you're going to owe taxes, then I recommend to go ahead and sell so you at least can pay your taxes. Okay, some other examples would be an emergency fund. So you have an emergency fund, usually 3 to 6 months living expenses in case of medical emergency, a job loss, anything like that. Okay, or a down payment. If you say to me, hey, I'm going to buy a house in the next year, you want your down payment in cash now. You don't want it in stock in general, Airbnb stock specifically, because let's say you did that in January. You said, I got my down payment. Okay, it's in stock. Okay, now you're ready today to make your down payment. Well, you've lost 20 or 30% of that down payment. So if you need it in the near term, take it out. So step one, get whatever cash off the table for any near-term valid needs, okay? Okay, that leaves you with whatever you're left with. Next step is decide if you want to keep some percentage of your equity for the long term, okay? You guys are working Airbnb, you believe in the company, you believe in the mission long term, that's fine. say, hey, I'm going to keep X% for the long term because I believe in the company. For my clients, I typically recommend at most you keep 5 to 10% of your investable assets. But you need to decide what you're comfortable with. Okay. So if you decide 10%, you carve out 10%. Okay. Now you have your remaining shares that you haven't gotten cash out of and that you aren't going to keep long term. So 3 primary ways of selling those remaining shares. The first is sell immediately. Okay. It's simple. Just sell everything as soon as you can. So the window's open, you're ready to sell. Now, there is data showing that on average for tech IPOs, tech companies, the optimal way to do it is to sell as soon as you can. Okay. Now, the reality is that most of my clients are like, I can't get comfortable with that. Okay. So, but if you can, then that's a very reasonable option. The 2 other ways of thinking about it are you sell over time on a schedule. Okay. That means you sell some portion over a period of time in a regular way. So, for example, you may say, I'm going to sell 25% of my vested equity every quarter over the next 4 quarters. Okay. Now, the benefit is there are a few benefits. One is you don't happen to pick the single wrong day to sell when it's at a low point, right? It's going to go up and down. Another benefit is that you have more control of the taxes. You can spread that out over multiple years. Now, the value of the sell over time on a schedule is also it helps minimize the emotion. Okay, so what happens is you go every quarter window opens, I'm going to sell 25%. Okay, I'm not going to worry or stress or try to figure out, is the price high or low? Is it high enough? Is it low enough? You're just going to sell. It's kind of like you have it on autopilot. Okay. 25% a quarter, next 4 quarters, over a year, you're done. Or whatever period you want. You could do it over 8 quarters, 6 quarters, 8 quarters, 10 quarters. Now, the next version of this is sell over time on a schedule, but you sell more when the price is higher and less when it's lower. So you can set up price bands and percentages related to that. So for example, you could say, all right, if Airbnb is 150 or more, price $150 or more, I'm going to sell 50% of my vested equity. If it's between 100 and 150, I'm going to sell 25%. If it's less than 100, I'm going to sell 15%. Okay. This again minimizes emotions, but you're able to get more out when the price is higher. So these are ways of thinking about selling your equity. We're just seeing here, based on the poll, you guys you're highly concentrated. So this is the process that I walk clients through. I recommend you go through and say, okay, what do I need near term in cash? Let's sell. What do I want to keep long term? Let's carve that out. And then let's decide how are we going to sell these remaining shares. And pick a plan, get comfortable with that plan, and then just execute it. All right. All right, so now let's say you actually sell. Then what should you do with the proceeds you have from selling all your Airbnb? So ideally, what you do is you develop financial plan. You have both your near-term, your long-term goals, and you understand, okay, how are we going to use this equity to reach those goals? So the first thing with those goals is you want to understand what the time horizon around those. So if it's a near-term goal, that's different than a long-term goal. So near-term, I'm defining as less than a year or 2. Okay, and those are things that we talked about, like taxes. You got to pay that right away. You don't have an emergency fund, get that done. You're going to buy a house soon. Then that's a near term. Long term are things like retirement is the classic one. College, you have kids, paying for college is probably long term. You also want to understand your risk tolerance, right? I take my clients to a risk tolerance questionnaire. You can do this yourself to figure out, and you know your own behavior. Are you comfortable with risk or not? Okay. So then based on that time horizon for the goal, based on your risk tolerance, um, you can decide on an asset allocation. So some mix of stocks, bonds, and cash. All right. And for near-term goals, in general, you want to keep it in safer assets, which means cash or bonds. So it's reasonable if you have taxes or down payment, let's just hold it in a highly liquid, safe account like a savings account. Now, longer term goals like retirement, you want some mix between stocks and bonds. Um, and the longer your time horizon, the higher your risk tolerance, then you can take more risk and you have a higher percentage of in stocks. Okay. So for retirement, which is typically longer term, you want to come up with the asset allocation, and then you should invest in a broadly diversified, globally allocated, cost-effective portfolio of stocks and bonds. You don't want to mess around with picking individual stocks. If you look at all the data, you want to get the market return at a low cost. That is going to give you the best chance of meeting your goal. Okay, so let's talk about next steps. All right, so this is a framework for thinking about your equity. Do you have too much, and then how to sell it? Again, we're going to have Q&A in a moment. If you have specific questions that you want to talk about for your specific situation, then you can use this URL. And actually, let me just drop in this link in the chat. Then feel free to do that. And then before we wrap up, I just want to share one more story with you. And that is a story about bees. All right. So a few years ago, my wife said to me, "Hey, we got bees in the backyard. Can you just call the exterminator and let's get rid of the hive?" And I said to my wife, I said, "Honey, I got this. I can take care of it." So I went back there. Had a bunch of had some bee spray. Started to get rid of the bees, and then the next thing I know, I had a dozen bees all over my head, stinging me, and I'm not proud of this, but I completely lost my composure. I actually ran into the house through we have a sliding glass door. We actually had a screen door. I was so out of sorts, I ran through the closed screen door. And then it's only when my wife was able to hose down my head that she said to me, "Hey, honey, why don't you call the exterminator?" Called the exterminator, got rid of the bees, and that was it. And the reason I tell you this is because if you have the interest in trying to figure out all this equity stuff on your own, then you should do that. But it's important to remember this is a big part of your net worth. This is a really important decision. You can do it on your own, but if you do it on your own, this is going to be the first time you do it. You also have the choice of working with a professional who's been through it many times. And you want to think about that may make sense with something important like this, or you may end up with a bunch of bee stings. Okay, so that's my last story for you. Let's start the Q&A. So let me go. So actually, if you guys go into the chat now, I'm going to, I have questions. I'll look back now, see what questions I have. So it's 11:51. So the next 9 minutes, I'll answer whatever questions I have. So Jessica's question is, okay, owing AMT on ISOs determined each year you hold granted and or exercise ISOs, not just when you sell. Okay. So the question is for ISOs, the AMT is determined by, it's depends on the year you exercise your ISOs, because when you exercise, that ISO income, which is the difference between your strike price and the fair market value, counts as income for AMT purposes. Okay. So if you exercise in a given year, it's possible you will owe AMT on those ISOs. And the way to do it correctly is just go to a tax person and do it. If you want, you can do it. You can try it on TurboTax, but it's there's enough complexity there where I think it's typically worth doing that. Okay, so I hope that answered this question. I think somebody had asked, Min had asked, do you count the unvested RSU? I think Min is asking when you do your concentration. So for purposes of the concentration, no, I don't count the unvested RSU because you don't own it yet. If you leave tomorrow, you don't get those RSUs. So that's why I say vested only when you're thinking about concentration. Okay. Okay. Anne asks, what is defined as immediately, like the day after vest or before the current trading window ends? Okay, sorry. Immediately means within, for me, I guess when I think about it, I'm thinking within the trading window. It doesn't mean you have to do it, the day after you vest. What's helpful, though, I find, is to set a date. It could be, the first day of the trading window, the last day, the middle day, because then you aren't trying to game the price and say, okay, I'm going to get the best price and sell it on that day. Because you unless you can predict the future, you aren't going to know what that date is. Okay. Is the meeting recorded? The answer is yes. It's recorded. As long as you're registered, you will get an email in the next day or so. Yeah. Which will have a link to the recording. Okay, Bill asks, if we sell less than our cost basis, then we don't have to pay any gains taxes, right? Okay. So, short answer is, well, let me walk through here. So you have an RSU. Here's what Bill's saying. Let's say you have an RSU, you vest, it's $150 a share. Okay. And then you sell it for $100 a share. Okay. So your cost basis is at 150. It's whatever you paid for or got the stock at. So if you sell at 100, you have a loss of $50 a share. The answer is you don't have to pay because you don't have a gain. You actually have a capital loss. Okay. And the good news is, in general, depending on your specific situation, you can use losses to offset gains. Okay. So if you have other gains, then you can do that. And then Bill talks about this topic, which is we can't do tax loss harvesting because of wash sale rules. So let me try to simplify this explanation. So the IRS has something called the wash sale rule. Okay. What that means is if you sell a stock today, you can't buy back that same stock for 30 days. Okay. And the reason the IRS has that rule is because when you sell for a loss, you can use those losses, those tax losses, to offset gains. Okay. But if you could take a loss today, buy it back immediately, then that's all people would do. So the wash sale rule takes effect if you sell at a loss and then buy back within 30 days. Now, buying is you go in the stock market and buy it. However, the way the IRS is defining it, and most it varies by tax professional, but when you vest your RSUs or you buy your RSUs through the ESPP, those count as purchases, which means that the wash sale rule comes into effect. And what that means is you can't take that tax loss for that year, that tax year, but what happens is that loss is deferred, meaning it gets added to the cost basis of the stocks that you just purchased through ESPP or vesting. Okay. So I know that was extremely confusing, but the takeaway is that if you sell for a loss, you're going to be able to use it. If not immediately, then it just gets deferred to later. Okay. Okay. So Maggie says, still feel confused about the tax implication of selling ESPP immediately versus holding until qualified. Okay. So let me try to clarify that. When you sell your ESPP, as long as you need to meet two criteria, otherwise it's treated as ordinary income. You have to sell it more than a year after the purchase date, more than 2 years after the grant date. Okay, that means as long as you sell it, if you sell within a few days after the purchase, or within a year, actually less than a year after the purchase, you don't have to worry about the long-term cap gains. Okay. What I'm recommending is go ahead and sell it as soon as you can. You're not going to have to deal with that. It only becomes qualified after if it meets those two criteria. Okay, I hope that was clear. Okay, and we'll take one last question here. Wanya, can we use ESPP gain to offset RSU loss? Okay, got it. So, back to the conversation around the wash sale rule. Okay, if you get an ESPP gain, you have a loss in your RSUs, and the wash sale rule is in effect, that becomes a disallowed wash sale, which means you won't be able to use it immediately to offset the gain. It likely would get deferred. The loss would get deferred to the it would be added to the basis of whatever you just purchased through the ESPP and or RSU vesting. Okay. So these are and all of this is very dependent on your specific tax situation. If you want to know the answer to that question for your tax situation, then I recommend you talk to a tax professional and say, okay, here's the situation, what's going to happen. But in general, yeah, if the wash sale rule is in effect, then you're not going to be able to get it directly. Okay, so it is noon. If you guys have any other questions, then feel free to schedule time on my calendar. Or if you have questions that we didn't have time to answer here, you can just email me, tom@vestedfinancialplanning.com. Thank you, everybody, for taking the time to participate, and hopefully look forward to talking to at least some of you. All right. Thanks, everybody.